That inflation data woke up this equity market. Downside surprise and a surge in equities. From New York City this morning, good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, stocks pop, yields drop, inflation coming in cold. Speaker Johnson looking to avoid a government shutdown, and President Biden and Xi looking to find a compromise. We begin with the big issue, disinflation in America.
This is just a really big week for the market.
The
CPI data is a big data point.
The Federal Reserve still thinks that there is more work to be done.
They're vigilant around inflation.
Focused on inflation.
Very nervous about declaring victory and then having to undeclare victory.
Markets obviously very focused on the core number.
Inflation is above target.
Still an issue.
There is more to give in terms of inflation coming down.
There's a lot of disinflationary developments as of late.
Inflation's going to come down.
Is rowing in the right direction.
Pointing in the right direction.
Progress will continue.
It's just going to be slow and bumpy.
It's not something that happens overnight.
Going forward, we're going to have this push and pull about inflation.
The market is all about inflation right now and what the Fed's going to do.
And we're going to talk about it with PGIM's Robert Tipp and PIMCO's Aaron Brown. Aaron, can the Fed declare victory?
Well, they've now paused for 3 out of the last 4 meetings, and I think that the bar for them to hike from here, particularly with these numbers coming in, is going to be really high. It's not to say that if we were to see another inflation spike early next year that they couldn't hike again, but I think we're probably past the point now, at least with conditions remaining as they are, for the Fed to hike again.
Look at the way the markets responded to this. A slight downside surprise on headline inflation, unchanged. A downside surprise almost across the board, and yet you've got an equity market on the S&P 500 up by 1.3%, the Russell up by more than 3%, you've got the Nasdaq up by 1.6%, and Robert Tipp, in the bond market, we've got a major move at the front end of the curve. We're down 16 basis points. Maybe we need to get used to moves like this. I'm with you on that. On the 10-year, we're down about 15 basis points. It's a break of 450 again. In your mind, Robert, can we well and truly put to bed the inflation scare of the last 2 years?
I think we can. I think the Fed can't. And I think that is a great combination. You can see that all signs suggest that they're on the right path. Yields are up in a very healthy zip code for investors. And this is a fantastic environment where they're probably not going to have to do anything else. They will be on hold. But from their standpoint, they know where they want to be, which is kind of this situation I'm alluding to of inflation slowly coming back to target. They know where they definitely don't want to be. They don't want to be in the 1970s, getting all choked up, because that was a terrible period, and there are a lot of false dawns. And the Fed, even in this cycle, has had false dawns. So they're going to stay pretty tough in holding their line against an early declaration of victory and keep rates high here, I think, for longer than people think.
Let's dig into the details. Headline, year over year, 3.2. Core, stripping out food and energy, 4.0. With the numbers, let's get to Mike McKee for more. Morning, Mike.
All right, let's take a look, John, at the good news this morning. You've already been talking about the reaction to it. It came in flat on a headline basis, helped by a 5% drop in gasoline. Nobody was surprised really so much by that, 3.2% year over year. But look at the core, 0.2. The lean was to maybe a 0.4, and so things changed there drastically and pushed us down to the lowest we've seen in quite some time, and it puts us at 4% year over year. Health insurance did go up, as did furniture, but not a lot else did. Decreasing, I mentioned gasoline. All these things go up in price, but by a lower amount. Housing, the owner's equivalent rent was up 0.6 in September, just 0.4 in October. So good news there. New and used cars fell. Used car prices fell 0.8%, surprising a little bit to analysts who thought they wouldn't fall quite as much. And then Supercore, the one that Jay Powell likes to watch, this this was good news as well. After rising 0.6 in September, it rises just 0.2 in the month of October. Big drop there. And then the overall number for year over year drops to 3.75%. So we're seeing some good news. And then you look at the healthcare issue. A lot of people thought we were going to see a rise in health insurance prices. We did, because the government recalculates. But what it ended up happening was the rise wasn't big enough to make a difference. It still was a negative print for health insurance, and so that helps hold down the overall numbers.
Mike McKee, thank you, sir, for the update. Further disinflation might be in our future. Neil Dutta of Renmac. Lots of response to this reaction coming through. Here's one point from Neil this morning. Here's the quote. There is likely additional slowing in consumer prices on the horizon, particularly in core consumer goods. With the US economy holding up, the inflation data are soft landing nirvana for the equity markets. Erin, let's talk about that soft landing nirvana for this equity market. If you believe in further disinflation, I think we've got to have a conversation about what we're converging towards. Are we going back towards 2, or are we likely to get stuck around 3?
Well, I think right now what we're seeing is we're sort of gradually sliding into a softish landing. But I still think that inflation will take time to come down, and that will leave the Fed on hold longer than you typically see during a cycle. I think that the Fed is not going to, take its applause and take a bow with just one data print, and they're really going to wait to see through really the first half of next year to make sure that the data continues to confirm that inflation will fall. Now, I do think it will fall to a level slightly above what we've run in the pre-pandemic period. And so I think that's going to be the tricky argument, but it's probably a back half of the year argument and conversation that the Fed has to have, not one in the first 6 months of the year. What I do think is really confirms some of the supportive inflation data is if you look over the last year, and particularly over the last 2 quarters, what you're hearing from companies in the S&P 500 is that margin compression, margins, labor, all of those factors that really pressured margins in 2022 and also were the result of higher inflation are now starting to abate. And so we've now seen 2 quarters coming out from 500 companies in the S&P 500, all of which are suggesting that inflation is no longer as big a concern as it was in the past. And to me, that's what's most encouraging, the fact that you've seen such significant margin improvement in the equity market this year. And that, I think, is what's really bolstered equities this year and continues to drive some of the outperformance and enthusiasm today.
Do you see reasons then to bolster equities, for all of those things to bolster equities into 2024 then, Erin?
So I think it's going to be really a tale of two cities within equities. The easy margin gains were gotten this year. I think as we look forward into next year, the bar for earnings is really high. Consensus is looking for double-digit earnings growth next year in an environment we're expecting pretty low nominal GDP environment. Typically, that's not that doesn't make sense. Like, you don't have a low GDP environment and very high earnings. So I think you're going to see sectors that have gotten hit this year, that underperformed, that have clean balance sheets are going to be big performers next year, but sectors that are more highly levered, that are beneficiaries of this year's gains, like the home builders, auto manufacturers that are, leveraged to consumer credit, I think those are going to get hit hard. So, I think it's really going to be a bifurcated market.
That's the stock market call. Futures with a big move today. I keep looking at the Russell. The small caps up by 3.5% in response to this small downside surprise on inflation in America. The move in the bond market. Pull up bonds, 2-year, 10-year, 30-year. Look at the curve right now. Down and down hard. The whole curve shifting lower. We're down 18 basis points on a 2-year. We were north of 5%. We're back to 485 on a 10-year, a break of 450 again. Let's call that 447, 446 on a 10-year this morning. Robert, let's talk about this. The 10-year peaked at around 5%. The 2-year peaked at around 525. A lot of people now concluding that was the peak. How much of a rally do you think is in store in this bond market? What are the limits to that bond market move if you're looking for yields to move lower?
I think we're going to remain in this range. I think that, our base case, going back from when we cleared 4% at the end of last year, was basically that this is going to be an unusual bull market. It's not going to be a quick drop in rates, back to the levels that we were at pre-pandemic that's going to get you good returns. It's going to be simply the level of yield itself. So I think we're going to remain range-bound around these levels. It feels good here. It feels like 5% is going to be the peak for the cycle, but I think we could spend a lot of time in the 4 to 5% range. I think the yield is going to accrete into solid returns, but I think the other thing is that having the pressure off the Fed in terms of hiking is very positive for ongoing growth, and that is a very positive environment for credit. You really want an environment where corporate managers are cautious. You don't want them unduly exuberant and leveraging up. So this is going to be an environment where spreads are likely to fluctuate around these ranges or grind tighter as people work their way back into the bond market.
Robert Sipp, Erin Brown, you're going to stick with us. We'll work through some of these markets, including bonds and equities, going into the opening bell about 20 minutes away. This move in the equity market, phenomenal. To see equity futures up 1.3% off the back of a small downside surprise on inflation, speaking to maybe what the market expected, which was maybe an upside surprise on inflation this morning. Didn't get it. A move of 20 basis points lower at the front end of the curve on a 10-year maturity. We're down about 17. Let's get you some movers going into the opening bell. Here's Abby.
It really is an incredible move on this lower than, cooler than expected CPI print, John. Those Russell 2000 futures heading to the best day since early June. As for big tech, there's a big lift. Lots of FOMO here, fear of missing out on the idea that maybe if the Fed is done, you want to be in on these names that benefit from lowering rates as valuation is less of a concern. Tesla up 5%. Take a look at Snap up 6.6%. There's a little bit of an idiosyncratic story to Snap as well, rising on a report that Amazon's going to allow folks to buy from their ads directly on the Snap ad. And then Amazon itself up 1.8%. Really a big rally. It's going to be interesting to see if it lasts through the day, John.
A big move on the FX market too. Abby, thanks for that. I think that's the question at this point. Will it stick? But at the moment, the euro stronger against the dollar for a third consecutive session, reclaiming 108, potentially the biggest move going back to July. And as things stand, the euro the strongest against the dollar since late August. Turning our attention now, coming up on this programme too, a conversation on Speaker Johnson turning to Democrats to try and avoid a shutdown.
A handful of far-right radical Republicans could kill this, but I think they want to give, at least on this first bill, they want to give Mike Johnson a victory.
Attempting to get legislation to the president's desk as Washington inches closer to a shutdown. That conversation up next.
There's so much in the bill to hate. For the conservative Republicans, there are no spending cuts, and they're quite upset over that. For the White House and the Democrats, the fact that there's nothing for Israel or Ukraine is very troubling. And we can say, oh, we'll get them some money in February. Well, they need money now, and I think to not send our allies this money sends a very bad signal.
So everybody's unhappy, and House Speaker Mike Johnson is counting on Democrats. Lawmakers set to vote on his stopgap government funding bill in a procedure requiring a 2/3 majority, which Johnson can only achieve with significant Democratic support. Both sides of the aisle meeting separately to strategize ahead of an expected 4:20 p.m. vote. GOP hardliners making their displeasure clear over a lack of steep spending cuts. Democrats worried that the bill leaves out aid for Ukraine and Israel. Joining us now from D.C. is Katie Lyons. Morning, Katie.
Good morning, John. Well, as you say, because of the suspension of the rules that this measure is being considered under, it will require 2/3 majority. So 290 votes is going to be the magic number to get this two-step so-called laddered continuing resolution passed. It, of course, would continue a stopgap measure to fund the government so that there is no shutdown this weekend by extending funding for different programs to two different dates. First, January 19th, then a second tranche, including defense spending, to February 2nd. As you say, though, that because that this is a clean continuing resolution is what we call it here in Washington, which means it holds funding levels steady, does not give conservatives the deep spending cuts they were looking for. It is very likely that a number of Republicans are going to vote against this measure. That exact number is unclear, though enough have already come out against this bill that would mean that it does require significant Democratic support, again, because you're trying to get to 290 votes. Now, the Democratic leader, Hakeem Jeffries, heading into what he calls a family meeting this morning, did tell reporters that they are open-minded. Leadership has signaled that they are open to this plan because, yes, while it doesn't include Israel and Ukraine funding, it doesn't cut spending and it would keep the government funded and avoid a shutdown. So this might ultimately be very hard for Democrats to turn down. Then, of course, it's going to become a question of what exactly it means for Mike Johnson if this does garner significant Democratic support, keeping in mind, John, that the last continuing resolution that passed under Speaker Kevin McCarthy was clean. It required Democratic votes and it ultimately cost him his speakership. So Mike Johnson's future will be a little bit of a question here, as is, of course, the question open. What will happen when it reaches the Democratic Senate and ultimately President Biden's desk? Yesterday, he didn't suggest either way whether he's made a decision on signing it if it does make it to his desk or vetoing this measure.
It's like a sequel to the movie we watched only a month ago. Candy Lines, thank you. Dan in Washington, appreciate the update. Richmond Fed President Tom Barkin right now. The government shutdown impacts are historically modest. Robert Tipp, can we ignore this mess down in Washington?
You can't ignore it. I mean, it's disturbing. We have difficulties in just governing. And the ratings agencies are calling attention to this. The deficits are shockingly large for a peacetime expansion, peacetime for our country. That's something that on the margin is weighing on Treasury yields and is going to continue to weigh on Treasury yields. I think for the market, in terms of major disruption, the shutdowns are much less of a problem. Default risk, when you get to the debt ceiling, that's the big one. So I think in terms of the markets, it's less of an issue here. But in terms of the general trend of mild upward pressure on government yields versus everything else, that's a situation we're going to be living with for the foreseeable future.
Well, the trend right now is lower yields on my screen, lighting up big time. The 2-year down by about 19 basis points, the 10-year down by a similar amount. We're pricing in more rate cuts for 2024. That's the conversation as things stand. Aaron Brown, the conversation in D.C. has been the same one for the last 10 years, governance issues. Should those governance issues lead to higher yields? Does it make it more expensive for this government to finance the deficit, given the dysfunction in Washington?
Yeah, I think like the prior speaker just said, I think that the increased dysfunction that we've seen over the last decade or so does lead to more risk premium being priced into 10-year Treasury yields. And really, the dysfunction makes it more difficult for smooth government financing to occur, for the government to fund its deficits, to really, focus on its priorities. So I think that does, import some modest amount of higher yields on treasuries, but it's very hard to be able to disentangle how much is coming from, increased risk of government dysfunction. But I do think it matters.
This Treasury market just looks like a mess, Robert Tipp. Last week we had a sloppy bond auction on the 30-year and yields were surging by more than 20 basis points at the long end. This morning, encouraging news. Let's be clear about that. We want to see more of this. Less of last week, more of this. Further signs of disinflation. And Robert Tipp, we've got another move of 20 basis points, this time at the front end. Robert Tipp, what are you making of just the day-to-day price action in Treasuries?
Yeah, and I want to take you back through the issuance aspect again. If you think back prior to the August refunding announcement and the Fed's shift to a higher for longer stance, we were kind of down wrapped around 4% on the Treasury. And now we're up in more of like a 4.30 to 5% range. So I think the downgrades and the supply are really weighing on the back of the market more visibly than before. In terms of the day-to-day movements, that has been a feature. I think investors are really disoriented here. I think they're missing two aspects of the landscape here. The first one is that we were in a 10-year Treasury environment that was averaging about 2%, and now we're going to be up in a world that's probably in the 4 to 5% realm for the foreseeable future. As Aaron was alluding to, I think inflation is going to be sticky above 2%, and growth, for a number of reasons, I think is more resilient than people expect. As a result, even if you got the Fed funds rate coming down to 4%, and that is not on the Fed's radar, right, over the next year, you still, with a positively sloped curve, could have treasuries right in this realm. So I think the markets have not wrapped their head around the paradigm shift up to higher yields, which are much more normal. The second aspect is the cyclical. They haven't wrapped their mind around the fact that the Fed is likely to get marooned at 5 for quite a while, above 5, then a bit below 5. And that is going to be a serious influence on the bond market and the general range of yield. So while the market's in that realm of confusion, you're having these really violent day-to-day swings. And I think that's going to continue within an overall range around where we are here, kind of 4.30 to 5%.
What you just said is at the epicenter of a massive debate on Wall Street going into 2024, Robert. Erin, I want to share this view from UBS's Banner Buwaja, who says the following. We don't see the conditions for why this time is so different. Inflation is normalizing quickly, and by the time we get to March, the Fed will be looking at real rates, which are very high. The view from UBS is that rates fall to between 2.5 and 2.75 by the end of next year, and the terminal rate plunges to 1.25 by early 2025. Clearly, Erin, that's a view on the other end of the spectrum. Do you think they're wrong?
I do think that they're probably early in that call. Certainly I do think we'll see rates by the end of the cycle normalize back to the levels that they suggest. But I think in the very near term, it's going to be difficult to achieve, because what's different this time is that we really had an inflation scare that was persistent and well above the Fed's projections, either at the start of or the middle or even towards the end of the inflation cycle. And so it lasted much long. It was more of a supply-driven shock, which had ramifications multi-months and multi-quarters. And they continually had to revise up and were proved wrong with respect to, their expectation for inflation normalizing. And so I think that recent shock will keep them, a little bit more reluctant to aggressively cut rates this cycle, like you've historically seen during prior rate cutting cycles.
Too early to declare victory seems to be the conclusion from the two of you. Robert Tipp, Erin Brown, thank you very much for being with us. Inflation coming in softer, equities absolutely surging going into the opening bell. Coming up, the morning calls, and later, BlackRock's Gargi Chowdhury making the case for high quality stocks with steady earnings growth. That conversation still ahead. This equity market off to the races big time. Equity futures up by 1.4% as inflation comes in just a little cooler than expected. That's the price action. Let's get you some morning calls. Bernstein upgrading Kraft Heinz to outperform, saying recent declines are now overdone. Wedbush downgrading New York Community Bank to underperform, pointing to macro headwinds and a challenging lending environment. And finally, Deutsche Bank upgrading Take-Two Interactive to buy, expecting shares to benefit from popular new releases over the holiday season. Coming up on this program, equity strategists taking their positions on the year ahead. We'll get the outlook from BlackRock's Gargi Chowdhury. That's next. Your opening bell just around the corner. It's 25 seconds away from the opening bell this morning. Good morning. Snoozy start to the week. Big time snooze in yesterday's session. That inflation data waking up this equity market in a big way. The week begins right now with equity futures up by 1.4% on the S&P 500, up by more than 3% on the Russell, fueled by a downside surprise on inflation. There's your opening bell. Switch to the board and get to the bond market. Look at this for a move. Yields plunging on a 10-year, down almost 20 basis points to 4.44. It's a break of 4.50 on a 10-year yield to the downside. With that, tons of dollar weakness. A fair bit of euro strength on the euro right now, reclaiming 108 on that currency pair, the biggest one-day move higher going back to earlier this year, back to February. It's the highest on that currency pair since the end of August, 108.17. Crude with a rally up 0.8%, $78 and about 90 cents. 30 seconds into this session, equities moving one way. That's up and away. On the S&P 500, up by 1.4%. On the Nasdaq, up by 1.9%. What stock to watch at the open? Home Depot, the retailer, topping Q3 profit estimates, but delivering a warning about the U.S. consumer. Abby has more. Hey, Abby.
Well, John, if ever there was a day to deliver actually bad news. Home Depot talking about weakness ahead and essentially lowering the forecast. It was today because a rising tide seems to be lifting all boats. Home Depot heading toward its best day since November of last year. Now, a piece of it could be the fact that Home Depot on the year down 8%. So with this macro story developing around the idea that maybe inflation has been beaten and that yields are going to come in, the beaten down catch-up stocks are perhaps catching up. That seems to be the case with Home Depot. As for the quarter that was, they actually beat ever so slightly, but it's the guide. It's the same store sales down. They're looking for 3 to 4% down versus what had been 2 to 3% down. Earnings expected to fall 9 to 11% versus down 13%. Again, the stock up 4.6%. So a bit of that catch-up feel. Apparently, folks are still spending on small projects, but not so much on the big ticket projects. This stock, which had, again, been down almost 9% year to date coming into this print, closer to flat on sort of a mediocre report, but investors choosing to see the potential bright side.
That move, Abby, and Abby, thank you, has next to nothing to do with the numbers we got this morning. Let's be clear about that. This whole equity market is higher across the board. Every single sector on my screen right now is in the green. Top of the pile, real estate up by close to 4% as yields reprice aggressively lower. Consumer discretionary higher by 2.4%, utilities up by 2%, information technology up by about 1.5%. Let's stick on tech. Snap reportedly reaching a deal with Amazon, allowing its users to shop directly from advertisements on the Snapchat app. This according to the information. That stock, Kate, absolutely flying this morning.
Yeah, John, great news. Let's say that you're scrolling through Snapchat, you're taking a look at your friends' stories. If you come across an Amazon ad, you see a product that you like, you'll theoretically be able to shop directly from the app. Now, that is according to an Amazon spokesperson. It's been reported out by the information that U.S. customers would be able to check out with Amazon without leaving the Snap ad and also see the Amazon items' estimated delivery times, the real-time pricing, Prime eligibility, etc. Now, this is similar to a deal announced last week between Amazon and Meta for shopping in Facebook and Instagram, some of their app portfolio. And the thinking is that this could make these social media platforms more attractive to advertisers. We know that's been a challenge space, and that logic helps explain the currently 8% jump that we're seeing in Snap shares so far this morning. For 2023, Snap shares are higher by more than 35%, John.
Amazing. What a move this morning. Katie, thank you. What a move across the board. Let's stay on big tech. Let's stay on Apple. Shares moving higher after iPhone maker Foxconn topped profit expectations, signaling better demand for the devices. Ed Ludlow joins us on the West Coast for more. Morning, Ed.
Yeah, good morning, Jonathan. Apple up around a percentage point. It has pared some of its early gain from the open. Some of that momentum, of course, coming from the read-through into equities after the CPI print. But the catalyst is Foxconn, or Honhai Precision Industry Co., the main publicly traded arm of Foxconn, reporting third quarter earnings. They had a sort of surprise net income figure of $1.3 billion above estimates. But the outlook for the holiday quarter, the December quarter, was for sales to decline. That would represent the third straight quarter of sales decline. And given that this is the principal contract manufacturer or assembler of iPhones for Apple, the concern is that that is indicative of the downward momentum we've seen with iPhone 15 overall, tracking the third-party data as we've done on this show. It's also kind of a poor milestone for Foxconn itself. Analysts expect sales to contract 4% in the quarter, 6% overall for fiscal 23. That would represent the first full-year sales decline for Foxconn going back to 2016. Apple higher still, though, 0.9%. We always try and read the tea leaves of a name like this in the supply chain for Apple, but the market seems positive this morning, Jonathan.
Across the board, not just on this name. Ed, thank you. That name is up by about 1%, by the way, for whatever that's worth. The broader equity market right now, super constructive, lagging as you might expect in this kind of environment. Healthcare, staples, only 36 names, 35 names now on the S&P. Make that 34. It's moving as I read it. 34 names on the S&P 500, negative so far in today's trading. The rest of this market doing better than good. Let's turn to semis. Nvidia looking to match its longest winning streak in nearly 7 years, going for a 10th day of gains after adding roughly $200 billion in market cap this month alone. Simone Foxman on top of this one. Hey, Simone.
Hey, John. Yeah, NVIDIA really going with the flow this morning. Shares up 1.8%, but well ahead of the flow for this year when you look at 239, close to percentage point gains so far this year. The best performing component of both the NASDAQ 100 and the S&P 500 index. Yesterday, we saw a bit of a gain as well, despite a down overall market, 0.6%. Part of this was because of the announcement of an H200 AI processor. This is an upgrade from that game-changing H100 processor and using high bandwidth memory called HBM3E that allows these chips to bombard software with big data sets much faster. This is what you need to do if you're going to recognize data, if you're going to recognize speech and images. Extremely high demand. The company saying yesterday when it had made this announcement about the H200 that Amazon Web Services, Google Cloud, Oracle Cloud will all use it starting next year. But it's good for the company, which has seen more competition lately from the likes of AMD and Intel, a rare upgrade to these data center GPUs for NVIDIA. This new innovation, Bloomberg Intelligence says, will allow the company to defend its turf. Next catalyst also on the horizon, earnings November 21st, John, but so far gains today.
So thank you. NVIDIA up by 1.7%. Broader market about 7 minutes into the session up by 1.4%. NASDAQ up closer to 2% higher. Lots of reaction. Keep it coming this morning. This from Tony Dwyer of Canaccord saying inflation isn't going to be investors' problem once the rally into year-end plays out. Goes on to say the main issue would likely be the reason for less inflation. This is what Tony has to say. Weak economic growth. He says, though, acknowledges that is a topic for a different day. It's not the topic for today, that's for sure, based on the price action we see on the screen, with the Russell up by more than 3%. BlackRock's Gargi Chowdhury discussing the outlook for markets, writing this, quote, historically, the end of a Fed hiking cycle has spelled good news for bonds. We believe the time has come for investors to step out of cash and capture opportunities in fixed income. Gargi, I'm pleased to say, joined us right now. And I'll say this up front, Gargi, you did publish this, you wrote these thoughts before this number this morning, not off the back of it. So let's start there. Why is now the right time to move out of cash? And do you think we've seen enough to really break the wall of that money market dam?
Sure. Good morning, Jonathan. It's great to be here. So, as you said, the note was certainly written before today's excellent CPI print, something that investors should be celebrating. And the reason we think that investors should be stepping out of cash is we've done some work around this, and the right time for investors to outperform cash in both high quality parts of the equity and fixed income market is not actually when the Fed cuts rates. It's that period of pause. And I think based on the data today and based on the payroll data from 2 weeks ago, we can safely say that that period of pause has now begun. So I think we have a really great 6 to 10 month opportunity where high quality fixed income and high quality equities will outperform cash, and the $8 trillion of money market funds that are sitting around globally should hopefully be stepping into the markets, and we're beginning to see that in ETF flows already.
Agagi, just build on that. 6 to 8 months of equities and bonds performing well, or specific parts of the equity market and not the index?
Yeah, so let's start with the fixed income market first, because I do think I have a little bit of a stronger conviction there. And, you know, we've been talking about that on this show in the past. We've talked about how bonds are back as an income generator in a portfolio, and perhaps even, especially in the belly of the curve, a diversifier in the portfolio. What we saw today in the CPI number was further proof to that point. Number one, the deceleration in shelter inflation. That was really heartwarming. It wasn't a good story. This was a shelter story. Number two, this print points to much weaker PCE, which, as we know, is the Fed's preferred measure of inflation. So weaker than expected PCE is going to follow this CPI number. And thirdly, the measure that the Fed themselves look at, the core services ex housing, that continues to decelerate. All of this points to a Fed that just does not need to be as restrictive. Does that mean that they cut rates this year? No, of course not. But it does mean that next year they will begin to open the window to lower rates, not as restrictive as they are. That benefits the belly of the curve. And by that, we mean the 3 to 7 year part of the Treasury market, the TIPS market, the mortgage market, tremendously, perhaps even the IG credit market tremendously. So that's one of the biggest convictions we have going into the end of this year and into the first couple of months of next year.
So, Gagi, a lot of people listening to this program right now will have heard a lot of people saying the same thing. It's reflected in the fund manager survey over at Bank of America. These numbers, 76% say the hiking cycle is over. 80% expect lower short rates, a record 61% are looking for lower yields, and just 6% see higher CPI in 2024. It's not for me to say they're wrong. The consensus could well be right. Gagi, I'm just wondering if there's anything that makes you nervous about next year, given how much we all got wrong in 2023.
Yeah, absolutely. And these are markets that definitely make us all very humble. So we have to consider where we could be wrong. And the first one that I think about is reacceleration, especially on shelter inflation. There are some measures of rent that have turned a little bit higher. So I am watching that. Number two is the labor market. It's all been around, and Chair Powell has pointed this out. He has talked about this labor market coming back into balance. He mentioned immigration 3 times in the last FOMC press conference, just in terms of the supply of labor in the labor force. If we see that the labor force is not back in supply, if we continue to see wages reaccelerate, if we continue to see jobs growing at 200 or even higher than that, 1,000 per month, I do think that sort of raises a question of the Fed having to do more. They might not want to, but for them having to do more. So that's certainly a worry. And then I am also worried around deficits. Obviously, watching some of these debt to GDP numbers, looking at the interest expense as a percentage of payments, those are some concerning numbers. But I think that plays out in the longer part of the Treasury market. I think that's a concern for the 30-year, maybe perhaps the 20-year. I'd still like to keep the duration a little bit shorter, but certainly those are concerns on the horizon, and we have to remain humble about them.
Gagi, it's really interesting that when I think about, and got you to think about what you were nervous about maybe getting wrong next year, was that the economy could outperform your expectations, not underperform. Could we have a conversation about the latter and not just the former? Because I got a note from Tony Dwyer just a moment ago saying that this rally can play out off the back of this disinflation stuff. I'll read the quotes here. Inflation isn't going to be investors' problem once the rally into year-end plays out. He's talking about equities. The main issue will likely be the reason for less inflation, weak economic growth. He says that's a topic, though, for a different day. Gagi, this morning, I think a lot of people are embracing the idea that the inflation scare of the last 2 years is over. We heard from Neil Dutta, Renmac. He said it was soft landing nirvana for the equity market. That may well be a moment in time and not the ultimate destination. Do you think we've paid the price for the effort the Fed has gone to get inflation down? And are these figures this morning a reflection of supply side dynamics and not the demand side hit that could well be in our future?
Sure, Jonathan. So I think it's a little bit of both. There's certainly a little bit of supply dynamics, which is playing out in the goods inflation story. Obviously, this is the 5th straight month of deflationary prices in the goods category. But I certainly, when I look at the services category, I don't think that's just a supply side story. I definitely think there is a demand side story there. But I'll go back to your broader point, your earlier point, which is around when is this around a slowing economic growth? When does that come into the picture? Certainly, there has been a little bit of bite that we have seen on the consumer. When we look at the credit card delinquencies numbers, the auto delinquencies numbers, those are picking up ever so slightly. You need a magnifying glass. Certainly something to watch for. When we talk about our year ahead outlook, which is coming on December 5th, we're really talking about the next quarter or so for how ETF investors should think about the market, maybe the next 3 to 5 months. And I don't see a meaningful slowdown in the consumer in the next 3 to 5 months. I think when we look at the back half of 2024, there can certainly be some room for concerns there for the U.S. economy. But again, looking into the end of this year and for the first couple of quarters of next year, I think we're definitely going to slow down. We cannot expect to see a 4.9% U.S. GDP print. But I don't think those are negative numbers either.
Gagi, let's catch up again once that outlook is published in early December. I'm looking forward to doing that. Gagi Chaudhry there of BlackRock. Appreciate the update from BlackRock and the team. The S&P up by 1.5%, the Nasdaq up by 2%. You've got the Russell, the small cap, surging by more than 3%. If you're just joining us, you've missed out in the last 60 minutes. Inflation data coming in just a little softer, cooler, colder than expected. Not hot, better. More disinflation off the back of that. Equities absolutely surging. Bonds rallying too. Yields dropping aggressively, and the dollar a whole lot weaker. Coming up on this program, a high-stakes meeting between President Biden and China's Xi Jinping.
We anticipate that the leaders will discuss some of the most fundamental elements of the U.S.-PRC bilateral relationship.
Team coverage up next.
On Wednesday, as you have heard, President Biden and President Xi will meet in the Bay Area for a summit. We anticipate that the leaders will discuss some of the most fundamental elements of the U.S.-PRC bilateral relationship, including the continued importance of strengthening open lines of communication and managing competition responsibly so that it does not veer into conflict. The way we achieve that is through intense diplomacy.
National Security Advisor Jake Sullivan on Wednesday's high-stakes meeting between President Biden and China's Xi Jinping in San Francisco. The two leaders speaking for the first time in a year. On the agenda, an agreement that would see Beijing crack down on the manufacturing and export of fentanyl, potentially delivering Biden a major victory on an issue voters say is a priority for the 2024 election. Your team coverage starts right now with Bloomberg's Enda Curran and Nick Wadhams joining us down in D.C. Nick, let's begin with you. The priorities for this meeting for President Biden, Nick, what are they?
Well, obviously, fentanyl, as you mentioned, is a big one. But really what we're seeing from the Biden administration is a strategy that's aimed at essentially trying to arrest the slide in relations that's been happening over the last couple of years. And, you know, there's a real challenge there because while the U.S. has been sending numerous officials over to China to talk, to try to get this dialogue back on track, at the same time, you have both sides essentially accusing each other's armed forces of increasingly provocative actions in the South China Sea. So I think what you're going to see here is the administration really trying to thread this needle between saying, okay, we're going to stick up for our interests and call China out when we think it's doing something wrong. But at the same time, you know, we want this dialogue to continue. The big question coming out of APEC is, okay, what can you actually produce? A fentanyl agreement would be pretty interesting. That could be a deliverable for Biden. But beyond that, the administration is still grappling with where the relationship goes from here.
There really are incentives, though, on both sides to have some kind of breakthrough on something this week. And I'm thinking about the charm offensive that many were expecting, including myself, from Xi Jinping. And not just towards President Biden, but maybe towards corporate America. And what's in store?
Yeah, I think China's ultimate ambition, like Nick was saying, is to stabilize relations, but to send a message also that China is open for business. I mean, investor sentiment towards China has turned so negative, both in terms of investor portfolio flows and actual fixed asset investment in recent years, that the Chinese authorities are now really trying to turn that around. APEC, of course, is a great opportunity. You mentioned there will be that dinner with global executives, with Xi Jinping, after he meets with President Biden. That's, again, the kind of classic stage where President Xi will make the message that we're open for business, we're willing to work with you and to open up our market access where needed. So quite apart from the areas of tension on national security and human rights that Nick was talking about, I think when it comes to economics and trade, at the very least, Xi wants to stabilise relations and just say, look, nothing has changed, we still have scale, come and do business.
This is what makes it really difficult, I think, Nick, and you're dead on, right on, for pointing out the end game here. How does the president of China come across the United States and try and communicate to corporate America that we're a good place to invest after that negative FDI read that we had in the last couple of weeks, when we don't know what the end game will be for this relationship between the United States and China in the coming years?
Well, that's really the big question that is essentially on every single investor's mind in the United States. And, you know, there's in some ways not all that much that President Xi Jinping can say to counter or drown out the voices in the United States. I mean, China hawkishness, the hawks are so ascendant in the U.S. right now. President Biden is under so much pressure, especially from Republicans in Congress, but also among many Democrats, to impose more sanctions, more limits, more export controls. And, you know, it's just coming into 2024 in that election cycle, there's really going to be a very, very difficult task ahead for Joe Biden to say, listen, now might be the time for some sort of, if not accommodation, at least cooperation. And he has not figured out how to balance those two things. And needless to say, the pressure from Republicans in particular is only going to get stronger. So, I'm not really sure what Xi Jinping can say to corporate America to sort of alleviate those concerns and say, okay, it's safe to put your money here, especially ahead of 2024 and all the uncertainty around the possibility that Donald Trump, who just loves imposing tariffs, could bring those back as coming back into office in 2025.
And those Trump tariffs are still in place. Nick Wadhams and the current tricky time for both leaders. Two of the very best here at Bloomberg covering the big story over the next 24 hours. Coming up on this program, your trading diary off the back of a stellar rally so far this morning. What a move off the back of a small downside surprise on inflation. The small caps with the best move of the year so far. Let's get to the trading diary. Your day ahead looks like this. The House expected to vote at 4:20 p.m. on Speaker Johnson's stopgap bill. Wednesday, PPI and US retail sales and earnings from Target, plus Biden and Xi meeting on the West Coast. Thursday, another round of jobless claims and earnings from Macy's, Walmart and The Gap. Finally, Friday, the US government shutdown deadline. From New York, that is it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open.